Hey everybody, welcome back to another episode of The Smattering, where we ask the important questions about investing. I am Jason Hall, joined, of course, by the voice of the people, Jeff Santoro. Hey, Jeff.
Hey, I'm excited. We have two guests, our first double guest show. Last week, we had the opportunity to appear on the Power Hour for the Chit Chat Money podcast, and we have the co-hosts of that podcast here today with us, Ryan Henderson and Brett Shafer. How you doing, guys?
Doing well. Yeah, that was a fun episode, and I got a feeling this one will be too.
I agree. Great flow on that one. I think we could run it back on your guys' show.
Well, we're happy you guys are here.
Yeah, very much so. I think a good place to start. There's a good chance that if you're a listener to our podcast, if you're not a regular listener to Ryan and Brett, you're at least peripherally familiar with Chit Chat Money. But for those of you that don't, we wanted to start off with that. We'll talk a little bit about your backgrounds, and we'll talk about the podcast and what else you're doing. Who wants to go first?
I can talk about the backgrounds. And
That's Ryan, everybody.
Yeah, this is Ryan Henderson. It's actually kind of a funny story, I guess. So Brett and I both went to the same college, university, went to Washington State University, and that's basically where we met. And I ended up being a finance student. Brett was mechanical engineer, correct?
Correct.
But our paths crossed we were both kickers for the football team, and if you've ever watched a football practice, you'll notice on the side that the kickers don't do a whole lot. That there's usually a couple of people on the side that are just talking,
Right.
And so that was us, and it ended up kind of being.
Is that where you guys first made your stock prognostications together for the first time?
The bad
Probably,
ones, yes.
Yeah.
Love it.
In the 2017 era, when what was that, the least volatile year ever, the easiest year in market history, where you could buy something and everything went up about 20%. So
had a friend that it's a trader, and he mostly trades options, and he said that was the worst year he's ever had because there were no premiums because there was no volatility.
Perfect. That was great for us because we didn't know what we were doing, and you just bought some random stock, and most likely it went up.
And I think that was also the year Bitcoin first took off, right? Wasn't that 2017,
I think that was
2018?
Yeah.
The first bubble. Yeah, big. It was huge in the locker room, and that's what we kind of knew. Like, whoa, this might be, some people that were not interested in any of this stuff. There's about 20 people talking to us about Bitcoin and saying it's the future, and they have not. Let's say they weren't very.
They were giving financial advice.
They weren't very versed in finance. They might have just been a receiver that was about to go to the NFL next year. So, yeah.
But it was kind of like the genesis because everyone was kind of talking about it, especially young people, and so it kind of got us interested. And Brett, I'm thankful Brett was on the team because he actually had some, he'd read some of the kind of starter books, and so he knew generally some useful investing principles, and so since we had tons of time, we basically talked about it on the side. Eventually, we were like, we should. I think it was my sophomore year, your senior year, and we basically said let's try to start a podcast, and it was horrendous kind of at the start, and the audio sucked. I cringed every time I listened back to it, and no one really listened to it. Our moms gave us a couple voluntary listens, but that was really it. And the good thing was we actually enjoyed it, and so because we enjoyed it, we were able to keep doing it each week despite no one listening. And it was kind of a forum for us to actually get better. It taught us to research these businesses, taught us to kind of learn and kind of give ourselves a place to discuss ideas. And so I think that helped us improve. And then I'd say kind of 2020, after I had interned for the Motley Fool and Brett had hiked from Mexico to Canada, we reconvened and the podcast actually got good, and we got an office, and people started to tune in. It was also kind of the height of everyone had gotten their stimulus checks and wanted somewhere to put it, so they were listening.
Yeah, for a lot of people, there wasn't anything else you could do. Bars were still closed. Sporting events were just starting to get back open. Lots of free money floating around and people with time on their hands.
100%.
Yeah, that's kind of when it got serious and I guess turned into more of a real effort/business. So that was, am I missing anything there, Brett?
I don't think so. And then we just tried to get better year by year, day by day. We do 3 shows a week, different formats. Go listen to Jeff and Jason on the Investing Power Hour. And we do basically, we want to publicize our research similar to your guys' show ish, but ours is more, as we talked about.
You guys actually do
us
research.
we try to do, it's not extremely structured. I'd say go listen to the show to check it out, but we'll do what we call a not so deep dive, which is just trying to be ironic. And each week we cover a individual stock, go through the business model, history, governance, who owns the company, financials, and then kind of what we think about it, what we think their future prospects could be, go through bull and bear cases, and then kind of conclude with, all right, are we more interested in this company? And we think any listener along with us can kind of outsource a little bit of their research and get up to speed on a company a little bit quicker if they listen to one of our episodes. Plus, from our perspective, we put it out into the world, and then we get feedback from other people on the internet and saying, okay, no, you guys got this wrong. Actually, no, this was like smart. You guys, I didn't think of that before. And we can kind of communicate with people that way. So that's how we do it. Plus, we interview people on individual companies as well, kind of any other analysts we know, like yourselves, on the internet.
It's one of the things that I like about your format is that you do those kind of 3 different things. The Power Hour, of course, which is more talking about timely events. You do it live on YouTube typically, and then you push it out over the weekend for people that are looking to consume it more as a podcast. And then you interview really smart people, and sometimes me, talking about those individual companies. And then you have that the deep dives that you do. I love the way you phrase them, but you guys are really disciplined about having these formats that I think serve listeners really well, that are looking for specific things. And you talked about outsourcing of kind of out the not so deep dives, a way for people to outsource their research. I love that. And that's one of the things that we talk about here as far as like the investor toolbox. So we're all so busy with life, particularly because I think most of the people that listen to our show, like, they have a full-time job, and they don't, like, we try to help people figure out like the mindset things as much as the hardcore investing stuff. And you guys are really good at like the investing pieces when it comes to actually equity analysis and that sort of thing. And I think that's a real value add that you guys bring that. And I would like to, how did you arrive at that as a thing that you thought would be valuable, not just for as a podcast, but also as something that you guys really wanted to do every week?
So I think a bit of it was just stumbling into it, because we tried a few different formats at the start, and then what we realized was, because we tried to set it up as very similar to maybe how a sports show would go, where you have your own, us talking about something within the market, something news, something like that, and then interview someone. But when we were younger, or not when we were younger, but when the show was, just getting out the ground, we had no profiles really on Twitter or anywhere online. So it's hard to get, meet people. We hadn't really built up any friends within the industry yet. It was very hard to get interviews. So we thought, okay, what's something we can do on our own and doesn't require interviewing people? And I think we called it the Fundamental Analysis Show at the start, but then we switched it to Not So Deep Dive, just because we thought it had a better ring to it. And that's how we started. And people, go ahead, Ryan.
Originally it was the deep dive, but I mean, Brett kind of discussed the approach there for a second, where it's kind of typically, unless it's a business we've looked at before, it's our first time kind of turning over a rock, kind of doing our first level of diligence, if you want to call it that. And so people were like, we would talk about a business that someone had owned for 5 or 10 years, and they go, this is typically, it's of like, if we're bearish on something that they own or something like that, they'd be like, these guys aren't, this isn't a deep dive. And
you don't get it. You don't know what you're talking about, kind of thing.
To like mock it, we just converted it to the not so deep dive.
Well, and everybody uses deep dive, so I think it's kind of clever using not so deep dive. It's a little more original.
That's what we're hoping as well, because everyone uses that. And the key, I think, what we wanted also with the individual stocks is, I don't know if we just stumbled upon this too, or we explicitly thought this. Either way, it helps us out. Is each week, we cover a different company. Say, what did we do last week? Oh, we did this week, we're doing dating app companies. So we did Spark Networks, which is a tiny one. Then we did Bumble, Grindr. The next week we're doing Match Group. When someone searches that company, there might only be like, say, 10 or 100 people a year that search that company name or that ticker within to, say, Spotify, YouTube, or iTunes. But when they do, hopefully our show will pop up, and that's kind of what we found is a good organic way to grow the show when we were going from the standing start. And I think it's hard to do a postmortem because we don't really have many good analytics. Podcasts have as we all know, very hard analytics compared to say something like YouTube or posting on social media. So it's hard to know exactly what worked for us and how we could grow, and whether maybe it was just the stock market bubble in 2020, 2021. But I do think it was that searchability where people could find a show 5-6 months later, and that's what really helped us. So we just keep doing one each week and building the catalog out from here. So hopefully it gets better, each time we upload one.
The other thing that Brett kind of mentioned there is, like, it's more, if you're thinking about starting your own podcast, the interview format is a big part of it is having like regular programming. So having a show every Tuesday morning or something like that. It doesn't matter which day you pick, just pick something and stick to it and be consistent. And so it was hard to do that with interviews because, for one, we weren't big enough that like a lot of people would just turn us down. There were a lot of people that said yes, and we're really grateful for those that did, but a lot of people would turn us down, and so it made it really difficult to do. So we kind of just had to find something sustainable to do, and researching stocks in our own way ended up kind of, I think, being the most sticky format.
So I was one of those people that found your podcast during the pandemic because that's when I sort of got into investing and sort of obsessed with it. So it's been kind of fun, like hearing you talk through the history and how you've changed it. One thing I've wondered listening for a while now is that has it been hard or challenging in any way to like kind of publicly figure out the kinds of investors you are and make mistakes on the air and sort of like, because I'm sure you're changing as investors. Like I'm sure the way you invested, like you said earlier, like in 2017 in the locker room when you were, with on the football team and learning stuff is probably very different than what it is now, years later. So but you're doing that sort of publicly. Like I made all my mistakes privately before I started a podcast. So I'm just curious, like how that's been for you guys doing that out in the open.
I don't know. I think we try to make it limited where, at least recently, we've done a new format on the Not So Deep Dives where for our limited partnership that we run, we do a one episode per month that's kind of a cover. We call it the Arch Capital episode. It's kind of a marketing part of it is to be marketing for our fund, but we also want it to be good for the listeners where we'll cover something within the fund or maybe a reason why we passed on a company, why we're keeping it on the watch list, down those lines. And yeah, at that point, we'll talk about something we own, but typically, and we're not, our fund structure and all the, what do they call it, compliance stuff doesn't keep us from talking about individual stocks that we own, but we typically, and we won't not talk about a stock that we own, but usually we'll either, I don't want to say refrain from it, but we think it is smart to not, because we've seen a lot of people, without naming any names, we all know that there's tons of people out there like this that got in trouble during the bubble for, I don't want to say everyone was pumping up the stuff that they owned, but sometimes down that line where you say like, okay, I'm buying this, you should buy it too. We always try to make a full disclosure, like, hey, we own this company right now. We might not own it tomorrow. We might own it 6 months from now. We might not own it 6 months from now. We're going to go through everything we like, but we're also going to go through everything we dislike. We're going to try to say, look, we're not attached to these companies. And I think publicly saying that, or at least if not publicly saying it on the podcast to each other and then having people hear that and knowing that they're going to hear that, it kind of ties us to saying, okay, we own these things, but we cannot get attached. And when I say things, I mean stocks. We can't get attached to them emotionally because we know those biases are going to try to creep up on us. Ryan, I don't know if you have anything to add there.
I think something that honestly really helped, and you guys do it all the time, I think you do it knowingly, but something that really helped kind of, I think, it helped people resonate with us was self-deprecating humor throughout the show, like treating it like we are still learning as opposed to treating it like we're an expert on something, which is honestly, it gets kind of a little bit tougher when we now manage some money for people, because I think the inclination when you run some sort of a fund is you have to be all knowing on the stocks you own and that kind of thing. And so, and I mean, we're going to learn lessons along the way, and I think being open about that and kind of treating it as public research where we're trying to get feedback has really helped people resonate with us, and
Yeah,
and
but there
maybe
is,
has
there's going to be
allowed us to
criticism
avoid, I
when
guess, a
you're
little bit of
anywhere
criticism as
posting
well.
anything online, and especially within the investing, even if it's not online within the investing world, you have to have a thick skin. So luckily, I think honestly, and I know we already talked about both of us being kickers as well. If you're a kicker, and even neither of us played in college, we were third and fourth string or second and third string, but if you're a kicker, you have to have tough skin, and you have to realize
And a
that you're going to
short
make
memory.
mistakes, and you have to have a short memory, and you have to have understanding of probabilities, because even the best kickers ever, like Justin Tucker, are going to only make 9 out of 10 of their kicks, and they're going to miss 1 out of 10. That seems super easy. So I think having that as a base when we were younger was really helpful, because we had experienced a lot of situations as a kicker where you have a lot of pressure, you have a lot of things go wrong, and then you just have to move forward, if that makes sense.
Yeah, it does. I mean, there are a few things that can be more humbling than investing and being something like a kicker. And being a kicker is kind of like being the umpire or the referee that generally nobody knows who the hell you are until you do one thing wrong. And then everybody knows your name, and it's not a very, very good thing.
No, you have to build up a thick skin quickly.
So let's talk about this. I think this is a good transit. So let's, from the time you started Chit Chat Money, talking about the salad days of the stimulus money, and you couldn't swing a dead cat without hitting a stock that was going to double in the next 6 months. It was just kind of a crazy time. And it was a great time to be starting a podcast versus, say 6 months ago when we started this podcast. But it's also been a very different time to be an investor, where now it's far more, this is a stock picker's market, right? And you have to have honed this skill set to identify really the best companies and not just okay companies, and pay the right price and be willing to hold through volatility and all that sort of thing. So I'm really curious, thinking beyond the podcast, thinking about yourselves as investors, specifically, how have you evolved over the past few years?
Yeah, I can kind of take that, and Brett's answer might differ. But first of all,
We are not the exact same investors. I think we do have differing styles.
we do have a lot of similarities, though, and I would just say it's kind of, even though it doesn't feel like it now, it's kind of a blessing, or I should say we're really fortunate to have had the last 3 years be our sort of formal introduction into investing, because I think if we started in 2010 or somewhere around there, I probably wouldn't care a whole lot about valuation. That wouldn't be sort of a big part of our approach.
You'd be
Um,
learning to care.
yeah, that's exactly. But with everything that's happened over the last 3 years, it feels like we've gotten sort of a full cycle education in
Mhm.
a fraction of the time that it typically takes someone else. Also, it happens sort of at a time when, candidly, we don't have like dependents or something, like we're
The
not
stakes are
like,
lower.
yeah, absolutely. Like it could have been, in our 50s or like right before retirement or something, it would have affected us a lot more. But I I want to be careful not to take away the wrong lessons over the last kind of 3 years. But for better or worse, we have, or at least I have, become way more, I think, valuation conscious, and I'm very, and even though we kind of thought we were at the start, I think we really did not have a strong enough appreciation for base rates, and we assumed that a lot of these companies that were growing at pretty astounding rates, like we estimated that they could grow at a higher rate than they really could have, and I'm sure a lot of people did. That's why, a lot of these stocks have come down. But I'd say that's probably the biggest lesson, is that we're much more, I think, price discipline, and as a part of that, it's because we are pretty conservative in our assumptions now. Would you kind of characterize that the same, Brett?
Yeah, and I think it comes from a little bit of trying to just learn from how a market cycle goes, and the second is just frustration, because our own I don't want to say our only losers, but really the vast majority of any losers we've had over the past few years has been ones where we go, this, we love this business, but it's trading at approximately 20 times gross profit. I don't know. I think it can grow 20% through the next 5 years, but 5 years from now we'll be good. we'll be good. And then we were
Or
like, yeah, let's.
if it's a part of your initial thesis that you can average down, it's probably not
You
a
might want to think
prudent
about your
investment.
starting point. Yeah.
Yeah.
Yeah. The simple thing is just saying, look, we're going to identify a lot of those businesses. And this is something we've somewhat formally, I mean, it's only been the past few months we're trying to really build up this watch list, is look at a company. And when you say, hey, I really like this business model, I really like this business quality, a few companies that come to mind that we've kind of are going to put on this watch list would be something like Adyen, Airbnb, Coupang, something like that, where we don't have to buy it today. We can keep it on the watch list. We can say, okay, this is around the price or around the multiple that we're going to buy it at. But valuation does matter, at least to us. And we're not gonna overpay just because we want to think we have some cash on the sidelines and we want to get over antsy. And then I think the second thing that we really learned over the past year is trying, and this is something I think is going to take multiple years for us to really, and no one can really master it, but it's analyzing a management team, analyzing whether they are aligned with what you want as a shareholder, and if it's not expecting them to change to you. We're not activists. We can't change the narrative of what's going on. So typically a management team is going to be the same as they were. You can't expect them to do something different magically. And we did
Particularly
make
if
some
their
mistakes.
incentives are aligned in a different direction.
Yes. And 2020, 2021, early 2022, I think was a perfect time to be studying businesses, be studying proxy statements, be studying management teams and saying, oh, wow, these guys totally, maybe not intentionally lied. Now, there's a lot of people that did intentionally lie in 2021 and 2022, but they could have been misleading. They could have paid themselves huge bonuses for these weird metrics that didn't actually matter. And I think that was a good lesson for us to learn, where we made a couple of mistakes, not nearly as bad as I think as the valuation ones, which I think caught a lot of people. Anyone that wasn't a deep value person got caught up in that in 2020, 2021. It still is something that we want to focus on more than we had when we were younger, and we think it's important because you want a management team that's aligned with outside shareholders. That doesn't mean only focusing on shareholders, but focusing on what's best for that particular business to build shareholder and stakeholder value over the long term.
So you guys mentioned that you have a lot of similarities as investors, but that you also differ in some ways. So I'm just curious, like, how you would characterize where your differences lie. And then when it comes to making, like, what I'm assuming is a joint decision, right, with the fund you guys run, like, how do you reconcile those differences?
Well, I think
Specifically, what do you disagree about, and will you have an argument here for us on our show?
Yeah, we don't. We try not to do arguments. We try to make it debates. I think it's really hard to be introspective. So I think maybe it's easier for us to say what I think the other person doesn't. I don't know, right, Ryan? Because it's really hard to tell what I'm sure you have some things that I differ from you on. I don't know if you want to go first on that.
Honestly, we are fairly similar. Maybe just like domain expertise in some ways is a difference for us. Like, okay, I love to have some sort of tangible experience with the businesses we buy.
Yeah.
Something where it's like I have interfaced with the product in some way. Like I know the customer experience wholeheartedly. I think that's less of a point of emphasis for Brett.
I agree. Yeah, I agree with that. I think that's a big thing, but it's a good balance where I might get, as someone who studied kind of in the STEM area, think sometimes, or maybe have a little bit overconfidence in studying something that might be technologically complex, possibly something like semiconductors or anything within that realm. And we have a good balance where I'm like, hey, Ryan, you have to step out of your comfort zone here and buy some. There might be an opportunity to buy something that is a great opportunity, but we're not going to be able to buy it at the local store and test the product. And on the other hand, Ryan could be like, look, no, this is a tough market. This is hyper competitive. There's disruption coming every year. We might want to sit this one out. So I think that's a big difference.
And in terms of process, it's like, I guess our formal process is that one of us, if we're, hung up on an idea, we really like something, it's maybe a new business that's not in the fund already, we would pitch it to one another. And then, like Brett said, come up, unless it's like buy now. It's typically come up with a price where we think it's attractive, and having that sort of watch list to revisit when the price gets there makes it, I think, an easier decision when the day comes.
Yeah, and there's some other, important intricacies we can go in if you guys want to hit on the process part. But one important thing is we also have to have both agree on a sell decision, because we want to have resistance to selling, because we know some of the biggest mistakes people have made. I was just listening to Einhorn today saying that he used to own 3% of Apple back when, or like 2% of Apple back when Steve Jobs just came back before they released the iPod, and then they sold when it went like had a 40% bump. So they could have had, he could be the best fund manager ever if he just would have held on to Apple. And and look, he's also very, very good regardless of that. But he said that was his biggest mistake. I think a lot of people say their biggest mistake is selling position, and we don't want to do that as well, because we felt it. I think we've all felt it. When something is up 30-40%, or something has a bad quarter and you think you're wrong, your instinct is to make an action. And we want to make it, resistant, because there's going to be one day where I wake up and I'm like, dude, we have to sell this now. We have to sell this. And then Ryan's going to be like, no, we have to both agree. I don't think this is the right time. Sit on it and talk to me tomorrow. And then also it could be vice versa. I mean, we've had both those situations happen.
It's annoying at times to have to convince someone else, but it also makes you do deeper work, because if you have to convince them, you really have to be, it requires a little more depth of a knowledge when it comes to making a decision.
I think this is really compelling, because, and Jeff and I, we've talked about this before, how it's pretty common for people that are in the cohort that'll listen to our kind of shows. They're not necessarily surrounded by a lot of people in their personal lives who are as interested in investing in stock picking as they are. And it becomes this solo venture that, frankly, it's so easy to lose perspective. And it's so hard to, Brett, I believe you're the one that said, talking about trying to learn the right lessons. Like, it's so hard without having somebody else. And kind of to put a wrapper around this part of the conversation, Ryan, Brett, it sounds like you guys, like, you're very philosophically aligned with as investors. But where you different are your circle of competencies, and also a little bit of kind of the things that you prioritize that are in nuanced ways. And I think that is so healthy and that is so useful. And I just want to use this as a chance to talk about that toolbox again for people listening, to try to find somebody that you can interact with in that way, that can help you learn the right lessons, avoid the mistakes that are the ones that are really devastating, which are usually selling based and not buying based. That's great. Jeff, you look like you had something to add here.
No, what I was thinking as you guys were talking through that is the things that I've picked up, well, from listening today, but also just listening to your podcast before. Like, I've really loved the idea of, I've always had the concept of watch list in my head, but really having it be more about a company that I would love to buy, just not at the price right now, but keep it there, so that when we do hit these, like, who would have, maybe some people did, but we didn't really see 2022 coming the way it did, right? With this long prolonged bear market. But I'm thinking about myself, like, if I had some companies I bought at really high valuations in 2020 and 2021, if I, instead of doing that, if I had them on a watch list with like a price or a price range, I would have gotten them at much better prices over the past year. But I agree with what Jason said too. Like, it's so helpful to have someone, whether it's a formal kind of process like you guys have because of the fund, or just the way that Jason and I are able to talk through things on the podcast, and then, on text message and things like that, just to check yourself. Because you will, like you said, Brett, you'll wake up one day and be like, I have to do this thing right now. And it's good to have someone to be like, well, hold on, at least think of this other side of it. I usually try to do that for Jason, and by the time I'm halfway through my argument, he's told me he's already made his decision.
I can
click the button.
I can verify.
Yeah,
we try.
And I think as an individual, it might seem like a hellscape sometimes, but the best play, just post on Twitter and say, like, I think
you'll get an opinion.
Yeah, you'll get some opinions out there. Say, I'm thinking of selling this because of blank, blank, blank. You'll get an opinion. And if you're anyone that does feel like, hey, look, I love investing, but I don't have anyone to talk about it with, again, go on Twitter, go on Substack, start writing. I mean, really, the internet's the best place to do that.
Yeah. All right. So let's move into some more fun questions, just kind of about stocks and a little bit more in the wheelhouse of what you guys typically do on your show. One of the things that I like to ask people who come on the show, and it's sort of a generic question, but I think it's interesting, and you guys can answer this any way you want. It can be personal, it can be the fund, but best stock pick, worst stock pick. What's the decision you made that turned out to be the best, at least so far, and maybe one that was a real disaster?
I mean, technically, I think it's like in college one time we punted on this one, like just a like call option way out of the money, and it just like turned out to be great. But like I don't recommend that, and if we were doing that today, we wouldn't do it. But it
That's
was
too
kind of
wonky. That's too wonky.
we were
Yeah.
gambling, so it doesn't that
Yeah.
we avoid that. But I would say for me personally, and this is kind of ironic given the conversation we had last week, I think Square was actually the best investment that I made. Just
2018,
like
2019,
COVID. Well, basically, like kind of, I think I tripled down or something like that, like during COVID.
March. Yeah. Early April, COVID 2020.
And then it was like kind of just like good fortune that I ended up needing to like liquidate my personal portfolio to like invest in the fund and the podcast to get things up and running.
Yeah, our startup cost, yeah.
And ended up selling Square at kind of a fortunate time as well. So it ended up being the best investment, but I think it's funny just given that we look at it now and like I it would take a lot for me to own that now, just given sort of what my thoughts on management.
Yeah, I'm trying to think of the best one. I think it's got to be Square too, just because we were both kind of had similar timing on that, and we just kind of got lucky, and we kind of saw the Cash App numbers, and who knows, maybe they weren't legit now, but that gross profit growth, and either way, their financials were growing insane, and it seemed like there was a dislocation in March 2020. We ended up being right. Worst investment,
I think it's Spotify.
let's see,
money like just nominally.
Oh yeah, because we weighted that way too heavily at just to be frank, we weighted it way too heavily at a premium valuation, and yeah,
which is
I
think it's an important lesson, because I would say out of all the businesses we've looked at in our 5 years of investing, or maybe more, it's probably the business we know the most intimately, because we interface with the podcasting side. Maybe you guys, I don't know what you guys distribute on, but we see the publishing side of things, and we thought, oh, there's all this opportunity, yada yada yada. And because we knew the business so well, I think we conflated it with return potential, and we're kind of looking past the valuation, which is like some of the best investments we've made were ones where we probably didn't know the business all that well. Like Sprouts Farmers Market was a good investment for us.
Oh, that was my best investment, I think, personally. But go ahead.
Yeah,
I can't even remember. But
did we know the grocery business as well as we knew Spotify? No, but like just completely different return or results. It's just knowledge doesn't make it any more.
So
It doesn't change the outcome.
This is the sunk cost fallacy, right? And it works with
Yeah.
time as much as it does with money, where you have an idea that you invest so much of your time into really learning really well. Eventually, you can talk yourself into investing in that idea, even if the outcome of all of that labor is no, right?
Yeah.
It's,
Oh yeah, you see that all the time.
Yeah,
You see it all the time.
Yeah. So
here's one thing to go along with that is we were, for the majority of the KPIs with Spotify, we were right about what happened, but the price was too high. And yeah, it might still work out over the next, say, 5 to 7 years, but it wasn't right then, and it was a big mistake to load up on something as a heavy position sizing at that valuation, because it's a stock, not just a business.
The difference between a great business and a great investment, they're not always the same thing. But I want to put some numbers on that the block win, the Square win, just for some context. From March 23rd, 2020, the bottom, through basically any time from early January of 2021 through like the fall of 2021, for 9 months or so, if you had a sold, you would have realized between 400 and 600%, right? That's pretty good money if you can find it. That's incredible.
Yeah.
The thing
a lot of luck, I think.
Yeah, that
a lot of luck, but Hey, we're right. We're right at the business, but a lot of that was multiple.
But that's the right. I mean, that's the right lesson to learn. Is that you did. You know what? It took skill to identify it as in March of 2023 when the world's on fire and people are literally dying, and say, okay, this is an overreaction, and we think this is a deep value opportunity, and we're going to make money. The luck part is not that it went beyond just recovering to prior levels, and that all the STEMI money and all the other weirdness that continued to happen let it be a 6-bagger or a 7-bagger for you, Jeff.
But or go ahead, Jeff.
No, I was just going to say it is luck, but it's also the skill of identifying it too, and also knowing when's the right time to say, okay, whatever it was, 400, 500, 600% is enough right now. But the thing that I was thinking as you were going through that is like, there's the lesson you learned with the valuation piece, but then there's also the lesson you learn about your own biases. And I feel like when we talk about learning lessons with investing, it's easy to focus on the nuts and bolts of investing lessons. Like, oh, I've learned more about how to value a company. I've learned more about evaluating management. I've learned more about focusing on these KPIs. But there's also I've learned more about the mistakes I'm prone to make, or the biases I'm prone to have, or like, you probably won't make the mistake of conflating personal experience with a product and the investment again, because like that's something you learned in this process. So I think both of those things it's like the mindset learning, but then also like the investing learning. I think that's important.
I think a big thing with Block too, we mentioned the management stuff earlier, is now people may disagree with us, and we kind of have a opinion now that the management team at Square was not for us, I guess, and they made a few things in our minds that were definite mistakes. And it's really, really difficult, especially when you made 500% returns in a short time period, and you think, man, this could be a big winner. This could be, my Apple. This could be something huge for me. This could be my Amazon. Knowing when to sell is so important, that when we're looking at a company, we want, and it's so hard to find them. And yeah, you're going to be wrong sometimes, but finding the management team that doesn't force your hand and start making what are, I'll say in hindsight, clearly dumb decisions, specifically with Block, that convince people, hey, I got to get out of this thing. You have to realize your gains. You have to find another place to deploy the capital. If you're in a business that's high quality and you find that management team that has high integrity, then you never have to sell. And it's the easiest game ever. I mean, what's the best example with this? Munger with Costco, right? He found Costco. He found it at the right price, and he's held it through periods of 40 times earnings for a long time when everyone realized how great the business model was. But he's not selling because that culture there is so, ethical, focused on the right things, and not buying a music streaming company to diversify and have your hip hop friend as join the board.
Right. The thesis never changed for Costco.
And that's because of the culture.
Yeah. And right. And that's an important, I mean, just to plug your show and also the one we did together last week, like we did talk about that a little bit on that, about, knowing why you own a company, knowing what the thesis is, so that if they do something that's not aligned with that thesis, you at least know the reason you owned it and can evaluate, like using the purchase of Tidal as an example, the acquisition of Tidal. If you really know why you own Square or Block, you can then look at that and say, okay, this is obviously a shift in a different direction to some degree. Is it worth staying for it, or is it worth selling? So like, but you can't make that decision if you don't know it. All right. So we did an episode on our podcast a couple weeks ago, or last week, actually, it was last week's episode, called Running Toward Fires. And it was basically, in light of the banking crisis we all just kind of went through, we wanted to have a conversation about, sometimes if you know what you're doing and you're careful about it, you should actually run toward the thing that everyone's running away from. So I was curious if there's any sectors or stocks or parts of the market right now that people are sort of, running away from, that you think are compelling and worth running toward.
I don't know if it's
got a good one, Ryan.
I don't know if it's anything specific. We own a lot of tech, and people seem to hate that right now. I would also.
I don't know what tech is, though. I honestly don't know what tech is.
Yeah, it's the worst. It's the worst descriptor.
I don't know what
a growth investor versus a value investor are the worst descriptors in the world. It just means you're arbitrarily putting yourself in some bucket because it feels comfortable, and you're not thinking holistically about how to make money.
Yeah, I totally agree with that.
Yeah.
But Ryan, any
Well,
Any ideas?
I guess something we've been doing is, so just full disclosure, we own Activision Blizzard, and that's one where obviously it's
Are you
basically,
playing Uncle Warren's arbitrage game?
it's in some ways, yeah, I guess, but it's like it's not. It's, I think the spreads, whether it's because interest rates have risen and you can get like 4 or 5% without taking risk, or maybe it's just that like there's more regulatory scrutiny now. The spreads are wider, so I guess having wider spreads makes me think it's a fire most people are avoiding. But if it's a business for us that we're comfortable owning in the situation where it breaks, like the merger doesn't go through, that's sort of a fire, I guess you will, worth examining in our opinion.
Yeah, and another one for me. Yeah, I totally agree with that. And specifically with merger arbitrage, we're definitely not merger arbitrage investors, but we'll invest in one if we would still buy it at the same price. I think that's kind of the only reason we'd hop in on one of those. And I think the fire I'm really interested in, and again, look at our portfolio. There's a few companies in there with that, which we publish on our website once a month. It's consumer internet companies. I know people call those tech, but I like to separate it into consumer internet, where a lot of these have, over the last year, they've had major foreign exchange headwinds, which, look, I don't know if that's going to continue, but it seems unlikely that the dollar is going to go on a bull run like that every year for the forever. And two, they came out of a bubble period, so advertising's been down or went through a trough. A few other things, and again, there's just the pandemic really benefited a lot of these companies, and I think people are turning away because revenue decelled for a few quarters. And if you still believe in the long-term competitive advantages of those businesses, whatever it is, it could be in any industry or any subsector, excuse me, of consumer internet companies, I think there's a lot of opportunity there because a lot of people have, I mean, those are some of the worst performing stocks, maybe besides software as a service, or maybe besides biotech,
So you're
or a
talking
few other.
like the Shopify's, Booking.com, basically companies that have a website and they sell stuff to consumers on those websites. Is that what you're?
Yeah, it could be an online marketplace. It could be a social media company. It could be in music streaming. It could be in dating apps. I'm thinking of those two are examples that we own. And
Gaming.
yeah, I'm trying to think. Yeah, any video games. It could be video games. Any basically consumer internet company where what attracts us to those in general are and not all of them have network effects. They have high margins because the distribution is free. And when you build up a brand, it can be it's easy. It's those type of businesses where
They have moats and favorable economics, basically.
Yeah. I'm trying to sum it up, but the low barriers to entry with all of these, really, but high barriers to success. And yeah, it seems a lot of babies have gotten thrown with the bathwater, at least in my opinion, within that sector.
Yeah, that's what I keep thinking. Like when you say consumer internet companies, what I keep thinking, hearing you talk through it, is like all the companies that got caught up in both ends of the COVID bubble, right? The ones that had the crazy run-ups and then the ones that had the crazy crashes, because the reality is the heights that they reached and the depths that they reached are probably overblown on both ends. And there's probably, like you said, babies thrown out with the bathwater in there, and value to be found because the pendulum swung so hard in both directions.
Yeah, look at Meta. We never owned Meta. We should have.
We actually called it unownable at the bottom.
I said it's
So did Jeff.
I still think
I will never own Meta, so I'm still on that boat. But whatever.
Here yes, it was on a. I don't like someone that's throwing money away into something. It just doesn't make sense to me. But when you looked at it, how cheap it was at the time and how strong Instagram and WhatsApp were. Yeah, I mean, hindsight's 2020, but that was pretty darn cheap. And I think that opportunity still exists for a lot of those consumer internet companies out there that might not just social media.
Yeah, I think that's fair. All right, let's. So we're gonna wrap up the stock picking part, and then I've got a couple of bonus questions that these may be the most important questions that we can ask you guys. But this is the third most important question right here. So we've talked about a lot of things. And this is something that we stumbled across from our mutual friend, John Ratanti. I'm sure John's somebody that you guys know pretty well, an investor that I deeply admire. 5 stocks, 10 years. What would you pick? Here's how we're going to do it before you answer. You guys are going to go back and forth on the first 4, and then you have to debate for the 5th one. Brett, you go first because Brett, you're going to go first because you've let Ryan go first on every other thing.
All right. I did. I do that just because it gives me more time to think. My
I
first
know
one.
that. That's
Okay.
why I'm making you
Next.
go first.
Next. Okay. 10 years. My first pick is going to be. I'm trying to think of what we rank our stocks every 2 weeks. I'm gonna go Match Group.
Okay.
I'm gonna go Match
All right.
Group.
I don't know.
Ryan?
10 years for me is like enough to, and I can't sell them. Like at a,
No.
oh, okay.
No, you just got to pick 5 and you're stuck with them for 10
I'm
years.
going to probably pick a bunch of things that I don't think will change, where like I just don't think the industry will change. I will go Hershey's.
Okay. All right.
Third, I'm gonna go. Yeah, what? I'm trying to think of. It's hard to do it all in your head. I'm gonna go. Amazon. I think Amazon. Yeah, hard to lose money. I think in that right now.
Okay. All right.
People
All
might
right.
hate
So,
might
go
hate me
ahead.
for this one, but I think along the lines of things that won't change, I'll go Philip Morris.
Ooh, Philip Morris
Ooh, interesting.
International
Yeah.
or
Yeah, not
Yeah.
Altria. Philip
Hey.
Morris.
Not Altria.
Not Altria, but Philip Morris International.
Hey, Altria's outperformed them the last 10 years.
Well, yeah,
So,
because I'll just
yeah.
we don't want to have that show. So, yeah. All right. So,
Yeah, we could do a whole show on debating the tobacco companies.
So
All
here's
right,
what
wait,
we're
is this
going to do.
fifth or fourth?
I'm going to give you guys a few seconds while I'm talking here to think about it, and I want you each to be thinking about your what would you pick for your fifth, and then I'm going to count to 3, and then you have to say it out loud, and then you get to convince one another what number 5 is going to be. So all right, so here it goes. Here goes the countdown. Ready? 3, 2, 1.
Nelnet.
Oh, Home Depot. Sorry, I wasn't synced it up, but all right.
Okay, so Brett, you were
Oh, this
first.
is going to be a good debate. Those are both
Nelnet
good
and Home
choices.
Depot here. All right, so now that you've both heard it, are either of you prepared to go with your colleague?
Well, Ryan, I'm debating you for your largest position, both professionally and individually. So I don't know.
Nelnet.
If there's not, I don't know if I have to do any more convincing for you.
Okay, I love Nelnet, but you brought up we did this kind of exercise a while back, and he brought up a good point, which is I like Nelnet because of the capital allocation historically and currently.
Management, yeah.
If management changes, it's not. If I'm betting on a situation where it's because of management, I wouldn't necessarily call it purely a never sell, because management can change. So
Home Depot can be ruined by management, though, pretty easily.
they could, but they've had a lot of managers. Nellet's only had really one head capital allocator.
Well,
I guess
two.
Yeah,
yeah. 1.5 semi co-CEOs. Yeah. It's just so cheap. Yeah.
I mean, it is my largest position. Yeah, I'm willing to, and I don't own Home Depot, so maybe I'll go Nelnet.
All right, there you go. Jeff?
I do agree with what you're saying, though. Like, I would be more willing to bet on management changing and possibly screwing up Nelnet than Home Depot in the next 10 years.
Yeah, I still think
just because I feel like I know you can mess up Home Depot, but like you also probably couldn't if you were like halfway decent at your job. Like, whereas I feel like Nelnet's got so many moving pieces, you really have to make smart capital allocation decisions.
Home Depot makes
makes
the any idiot list for me. The Peter Lynch buy business that any idiot can run, because eventually any idiot will run it.
Yeah, maybe it is now, but in the early 2000s, I think they had a CEO they had to change because they made the too much expansion. I mean, we could have someone saying we're gonna just put in $20 billion into Latin America and just light it on fire, you know?
Yeah, not impossible.
But I think it would take multiple years.
Less likely.
I think the difference now is the board for Home Depot. So it's too late. You've already picked Nelnet, so you can't even. It's too late. We've already hit
Nelnet. Yeah. Nelnet, but the biggest risk is management. Yeah. I feel like once you hit,
hold on,
after
it's not
like 7 years, 10 years, you want the least management risk you can get.
Yeah.
Because what's the executive turnover in the United States now? Like every 3 years,
About 3.
or even less?
Yeah, a little over 3.
Yeah, I mean, so you got to bet that it's going to happen because of these revolving C-suites with all these just mercenary CEOs, as we like to call them.
Okay.
All right.
You guys ready? You ready for the most important question?
Sure.
There's two. The first one, who's the better kicker? It's a two-part. Who was the better kicker? Who is the better kicker?
Yeah, I'll say I know for a fact Ryan had a much better stronger leg than me, but I was more accurate.
Yeah,
Okay.
two very different kickers, really. And I would say
So-
now I still play soccer on a regular basis, so I'm kicking a ball a lot. So I think currently I would go with myself on that.
Yeah, I'd agree with that. Yeah, Ryan plays more soccer than I
I
do.
love that you asked that question because I was going to ask the same one and we did not plan that ahead of time.
You complete me, Jeff Santoro. All right, final question. In my professional experience, engineering majors make far better investors than finance majors.
Of course. Yeah.
Now, comparing track records, who's been the better investor measured by returns, Ryan or Brett?
Our returns are kind of the same because we owned a lot of the
know.
same stuff going into the
I'm
fund.
trying to
and
think
now
of anything.
most of our money's all in the fund, so our returns are tied. But
I gotta admit, I don't track my returns, so except in the fund.
In
The
the
fund
fund,
gets
we
tracked every. Yeah, but
Well, then Ryan wins, apparently.
Yeah, because
Like,
I don't track. I have not tracked my returns, which maybe is a bad thing, but also could be a good thing. I don't know. So I think we're gonna have to pass on that one. Because were there any stocks individually, Ryan, that one of us owned that another person didn't, and it wasn't like a starter position?
maybe like way back when. Right now in my Roth, I own 3 stocks. I own Nelnet, Dropbox, and Autodesk, and it's more just been out of laziness. Like most of the research has gone into the fund, but I think those returns have ended up all right, just because of like Nelnet makes up the most, and it's done fairly well.
Yeah, my
So-
Roth is almost all Nelnet, and then IAC. So I don't know. IAC's been a pretty big dog, but it's not as big a position. So we'll see. Maybe Ryan edges out there.
Very Munger of both of you. Both laziness to the point of sloth, and diversification is a hedge against ignorance. Love it. Well done, guys. Well done. Very well done. Jeff, any last words?
No, I think we covered it all. We got the kicker question in, so I'm good to
Awesome.
go now.
That was the hardest one.
That was
Ryan, Brett, Chit Chat Money, great podcast. Be sure to find these guys anywhere you find podcasts. You got a YouTube channel. They can find you both on Twitter. You have a website as well where you put stuff together. We'll make sure to put all that in the show notes for anybody that's looking to get in touch with you guys.
Awesome. Thank you guys. This was fun.
Really fun.
Thanks for coming on.
Thank you guys.
Okay, everybody. As always, we love to give our answers to these important questions about investing. But friends, it's up to you to find your own answers. I continue to believe in you every single week. All right, Jeff, we'll see you next time, buddy.
See you next time.